In this session, we're going to talk about down payment with a second mortgage. You have a number of different types of down payments here. Percent down, some people want to put a cash down, some want a fixed loan amount. Like for example, $600,000 purchase, $400,000 first, and maybe $50,000 second. You just never know what the borrower is going to want to do. But let's go ahead and take a percent down with the second loan. We're going to select a fixed rate versus a variable rate on this particular loan. And when we go down here, it's the old 80-10-10 with a 10% down payment. So in this particular situation, we always structure those with a 20% down. We want to fix the amount of the first with the maximum so we don't have any mortgage insurance or anything like that. We'll pick 360 months for the amortization. We'll use a percent down because we're going to do an 80, 10, and 10. So that's going to make our down payment. And by the way, the offer price, $610,000 versus the list price of $600,000. As we're seeing in today's market, there's a lot of overbidding of properties. We know in San Diego, for example, there was 47 offers on one particular property. Makes it kind of interesting. So with a fixed rate, we'll just go ahead and you can type in free form, like let's say, for example, 5.95. We're basically done with the configuration. We want to make all loans have the same down payment, and that's all 5 loans. And earnest money deposit, 3%, no seller concessions. Make the earnest money deposit the same on all loans. Click OK. And now let's go ahead and review what we have here. We've got a $61,000, 10% second, $488,000 first. There's your second payment, no mortgage insurance. Debt to income ratio is fine at 36.56%. There's your 80, 10, and 10, 90% total combined loan to value. And most importantly, down here, the origination charges. Because, for example, if you were over 3%, and that would include some of the escrow fees, the issue you have there is that you will be out of compliance. Okay, and at that point, don't even bother submitting the loan because what you'll have to do is probably go up in rate to get more lender credit to reduce those origination charges. And that would be, for example, on a lender paid compensation. It can also have some ramifications on a borrower paid compensation. Let's go to loan 2 real quick. Again, we've got our 20% down, fixed rate second. Percent down is at 20% calculated, 80%. And in this particular situation, we've got a loan amount of with a interest rate of 4.75%. The reason why you want to do this is because it can have a direct impact on your debt to income ratio. It also gives you a chance to put 2 lenders side by side in a comparison to see which one actually has the best overall package. Sometimes those seconds, their administration fees can be higher, and you just want to be aware of that and be able to provide your borrower with multiple choices. That way it makes it much easier for them to make a decision on which way they want to go on the loan. Okay, that'll end this one, and thanks a lot for stopping by.